So good morning, good afternoon, and good evening to all the people from across the globe. Thanks for attending in large numbers today. First, let me introduce myself. I am joint managing partner of Vaish Associates Advocates. I am based in Mumbai and I head the tax department in Mumbai. The idea of this conference was of my co-moderator, Priyanka Jain. Priyanka, are you there on the screen? I'm not able to see you. Priyanka?
Yes, I'm there.
So this is Priyanka Jain. So you can see an innocent face, but behind this innocent face lies deep knowledge and a lot of maturity. In fact, for any complex tax or transfer pricing issue, I always consult her. She is an expert in transfer pricing as well as a tax litigator. Now, the idea actually came to her because constantly we are asked by many of our multinational clients two questions. What effect does this pandemic have on my existing transfer pricing policy? And do I need to do anything to change the transfer pricing policy as a result of the pandemic? We have divided this webinar into three parts. So the first part, we will be taking up the transfer pricing issues. In the second part, we will be taking up the permanent establishment and the place of effective management, in short, POEM issues. And in the third part, we will be taking up the residency of individuals issues. Now, I will be moderating the first part, and Priyanka will be moderating the other two parts. And I would recommend to the audience that you please keep on posting your questions. At the end of the panel discussion on all the three parts, we will move on to the questions. Now, let me take this opportunity to introduce the panelists. And as you would see, that our panelists comprise of mix of people from industry, from jurisdictions abroad, and of course the Indian experts. So let me start with our industry tax heads. So first, Shikha Gupta. Shikha Gupta is a chartered accountant, and she holds a degree in finance from the London School of Economics. She is the tax head of Hindustan Unilever, and she has been associated with Big Four chartered accounting firms prior to joining Hindustan Unilever. So idea of bringing in Shikha was to have somebody from the manufacturing sector give the perspective. In the same way, we have chosen Vijayashree Ranganathan. So she will give us a perspective from the service industry sector. Vijayashree is also highly experienced in taxation. She is the head of this VFS Global, heading the taxation division. And prior to that, she has worked in Big Four accounting firms. Then I will just take our international speakers first. So first, I will take Kevin Kian. Kevin Kian is a part of Anderson Network, and our firm is also part of the Anderson Network. And Kevin is the managing director of Anderson United States National Tax Office, and he's the global transfer pricing leader of the firm. We have a second speaker which we have chosen from Europe, and again from Anderson Europe. Marikla, can we see you on the screen? Yeah, so we have Marikla Tennessee. She is the European tax coordinator of Anderson Tax and Legal, Italy. And she has a lot of experience in international business reorganization, digital economy, and risk management, and more particularly the international tax issues. You have on the screen Mr. Ajay Vora. Mr. Ajay Vora is a senior advocate, and I think for the Indian tax fraternity, he hardly needs any introduction. He has argued many leading tax cases, and he is consistently regarded as the leading tax professional by several reputed tax journals and directories. Then we have Mr. Neeraj Jain. Neeraj Jain is my partner. He's based out of New Delhi. He's a transfer pricing expert, and he has also been associated with various landmark judgments on transfer pricing, which he has argued along with Mr. Ajay Vora. Now, let me just briefly talk about what transfer pricing is about, though many of you are aware of transfer pricing. So essentially, transfer pricing contemplates an international transaction, and that international transaction has to be with an associated enterprise. And briefly put, associated enterprise is a related party, which is defined according to certain prescribed criteria under the Income Tax Act. Now, when you have a direct or indirect transaction with an associated enterprise or a related party, whatever you may call, you need to satisfy the arm's length principle, and the legislation has prescribed certain methods to test the arm's length principle. Now, the primary factor which needs to be seen is the comparables, and the comparables which we choose are never absolutely similar to the tested party. So as a result of which, in given situations, you have to make adjustments. And as we go along in this presentation, you will find the importance of adjustments to the comparables because of the pandemics. The pandemic has brought about many strange things which we have never experienced before. So first, it resulted in a lockdown. It resulted in a complete shutdown of operations. Then when the operations started, people couldn't operate at the full capacity because of social distancing measures, as well as the restrictions placed by the government on the number of people who can work in the factory. Then there were supply chain disruptions. Then the customer demand also got adversely affected. Then there were increased costs because of need for maintaining hygiene, because of social distancing, because of need for dedicated local transport facility. And we had a big issue about the migrant labor. So there were a lot of industries who were employing migrant labor who had come from their home states, and they went back because they didn't have work. And now the challenge is to bring them back to the place of work. And we are going to see a lot of bankruptcies going forward in the small and medium business. So the question which arises is whether, and if yes, how to take into account the adverse effects of the pandemic on the transfer pricing analysis. Now, the obvious answer is that you please test it with reference to independent enterprises, whatever they would have done in comparable circumstances. But that is a sage advice which needs to be deconstructed. And the purpose of this webinar and the purpose of these experts is to help us deconstruct this sage advice. The starting point in any transfer pricing is examination of the contracts. And the contracts, when they were entered into, they were entered into based on the conditions prevalent at those times. Now, because of the changed circumstances, the independent enterprises are trying to renegotiate the agreements or simply not follow them strictly. Why? Because of the need to reduce costs, the need to conserve cash, and all this is required because of imminent business closures, because of the reduction in demand, which has resulted in reduction of revenues. Now, functional analysis is a key to transfer pricing, and let me give you some examples. So let us first talk about functions. Now, the people have started from working from home. So the place where they were working from has changed. The functions which they were performing have changed. Some of the functions have become redundant. Some new functions have been added to the existing people. So all this has resulted in shifts in profit allocations. Now, the same is also true as regards the management and control of risks. New risks have been added because there have been supply chain disruptions due to shortages of raw material, labor, and inputs. Existing risks may change in significance, such as inventory risk or a credit risk in relation to the customers. The economic circumstances have also changed. Governments have intervened to bring in fiscal, financial, and regulatory measures. And most transactions entered into earlier would now be rendered uncomparable. Business strategies have also undergone a change. Quite a few of them are just concentrating on survival. Some of them are moving beyond concentrating on survival. They are trying to do their best in the changed circumstances. So there will be changes both as a buyer and seller to reduce costs and to conserve cash on one side, and also to preserve revenue and market share on other. Then all of a sudden, the communications industry, it has profited because of this lockdown. Everybody is using internet, so there is a high demand for internet, high demand for video conferencing facilities. Many businesses will need to restructure because of the challenges which the pandemic has brought, and this will affect the transfer pricing also. New third-party supply and distribution arrangements are being evaluated. New intercompany arrangements are being evaluated. And, a company which previously did not have a comparable uncontrolled price may soon be having one. So what does it tell us in terms of some key practical takeaways? So I think first we have to recognize that there have been changes in functional profile of the entities involved, and there could be changes in the transfer pricing regulations across jurisdictions, and they need to be critically examined. Then we have to also keep in mind the BEPS package, particularly the actions 8 to 10 reports, which give a guidance on the arm's length principle, and what it says that you should be dictated by economic rather than paper reality. And I would tell the participants that they should resist from the temptation of shifting revenues and profits to low tax jurisdiction, because in this age and time, the cash boxes and shell company structures are just not going to work. This environment is going to bring in number of transfer pricing adjustments, be it on account of idle capacity or be it on account of extraordinary costs like inventory write-offs or restructuring expenses or forex fluctuations. Documentation to substantiate these adjustments will have to be maintained, but quantification of these factors may be difficult, and hence one may have to rely on substance over form principle. The traditional databases will be of limited use, and one may have to adopt a substance over form approach even for the creation of documentation, and one may have to look into new contemporaneous documents like minutes of the meeting or the records of the Zoom meeting, email correspondence, etc. Now, the short message which I'm driving is that transfer pricing alignment with the new business strategies is very essential. And I would just like to end my introductory remarks by saying that this uncertainty is also going to bring in a lot of disputes between the taxpayers and the tax administration. So I think more prepared we are in terms of our transfer pricing analysis, the better it is. With these few words, let us have an industry view, and let us start with Shikha Gupta, who will let us know what are the transfer pricing challenges which she is facing in light of the pandemic, and what are some of the strategies which she has thought about along with her colleagues to overcome that. Over to you, Shikha.
Hope I'm audible.
Yes,
Yeah.
you are.
So thanks, Pomi, for a very good introduction and for setting the stage. What I plan to share today is, not necessarily the experience of my own company, because as we are in the midst of this crisis, the issues are still emerging and evolving. And it would be a little premature for me to say that there will necessarily be a big problem. I think the presumption with which there has to be some thinking done is that this is a very extreme situation with adverse economic effects, which doesn't affect any one country or any one industry, but it is affecting the globe, and it has an impact on all the industries, some milder, some more extreme. And to that extent, one may end up burning the transfer pricing candle at both the ends, where you are short on profits in both the supplying country and the receiving country, a service provider country and a service recipient country. And therefore, the fundamental question of arm's length is necessarily about how to allocate or reallocate the risks between the two jurisdictions involved. Can it continue business as usual, or is there necessarily a case for reallocation of functions, risks, and therefore rewards? So I think taking a cue from where you started, that are we therefore looking at some differences in the way the arm's length standard is applied? Now, everybody knows that the arm's length standard is nothing but how two independent enterprises would be dealing with each other. This becomes difficult to apply in a particular situation because A, there are sectoral differences, which means the way industry, like maybe aviation is affected, is not necessarily the same in which a consumer goods is affected. We all know aviation is affected in a much more drastic way. Secondly, even companies within a certain industry will be differentially impacted. So we are no longer looking at a scenario where I would say that as a consumer goods company, the impact on my company will be the same as another one in the same industry. Why? Because let's say the sourcing patterns could be different. Company A could be sourcing something from, let's say, China, just to take an example, and it may have trouble sourcing it from China because maybe COVID was at its peak at a certain time, and company B may actually be sourcing from another country which may see a different kind of challenges. So the profitability therefore will become a function of a lot of the underlying operating activities and how they got impacted depending on what the sourcing pattern was, what the export pattern was, where the manufacturing footprint lay, etc. And of course, different countries are also differentially impacted. So a company which has, let's say, a headquarters in a certain country may have a different ability to reconfigure all its operations across its subsidiaries compared to, let's say, another group which may have a different footprint, a global footprint. So I think with that, let me move on to, and you rightly described that it necessarily has to, the functional analysis is the backbone of any arm's length analysis. Without doing that, one would never know what really changed, and therefore whether consequentially the benchmarking and everything else needs to change as well. Now, in my view, with the limited experience that we've had, and we don't know how long this pandemic will last and its effects will last, whether they're more medium term or more long term in nature, I would think that there are certain areas where one could potentially see differences in the FAR analysis. And I'm doing a little bit of crystal ball gazing also here, as we are seeing how companies are adapting to the crisis and finding opportunities out of it. One is that it may drive more local decision making. because the effects of pandemic and the regulations and the way governments are reacting and the way industries and companies are adapting to that government regulation has to be very locally driven. And to that extent, one may end up seeing a more entrepreneurial function being performed by local companies. And I'm taking the example specifically of Indian companies set up in India may end up driving more of entrepreneurial functions. And secondly, one would, on the contrary flip, there could also be certain types of central services or management support which may become much more agile and much more actively contributed by, let's say, the headquarters because of the experience in dealing with disasters, business continuity, communications to vendors, customers, employees, etc. And given this backdrop, one would really have to see what has really changed in the functional assets and the risk profile. Beyond this, I'm not sure if I take the example of a manufacturing setup, whether the functions itself of a manufacturing company will become very different. Of course, the operating decisions will change in a large way, and I will enumerate some of them. In a manufacturing setup, one could end up seeing repurposing of factories, reconfiguring of the network. So you may choose to deploy production which was happening in factory A to factory B now because of easier access, easier availability of land, labor, and the other factors of production. One may end up seeing changes to the pack sizes. One may end up seeing introduction of repurposing of factories to produce new products to meet the needs, like maybe producing more hygiene products and changing the product mix, for example. Idle capacity is also certainly something where on at a manufacturing site level, one would see varying levels of capacity utilization, some being almost fully utilized, some being very not really utilized much because of the local regulation and the federal structure that we see in our country. One thing to realize also is that in this whole manufacturing setup, the debate between fixed cost versus the variable costs becomes very important. And it also has ramifications on accounting. And what kind of ramifications it has on accounting is something that Bhumi has already alluded to, like inventory obsolescence. It could be relating to impairment of assets, etc. Similarly, on the distribution function side and R&D, let me take the example also of R&D. Like I said, repurposing of factories to produce newer types of products or different pack sizes or slightly different formulations may involve local R&D to get swing much more in action rather than waiting, because no one really in these times of crisis has the luxury of time to wait for a regular development or an R&D cycle going through all its motions. So one might see the R&D cycles and functions being redeployed temporarily to meet the demands of the crisis. Similarly, on the distribution front, one could end up seeing newer distribution models. We've been reading in the newspapers, and we're very aware that especially for consumer goods, there may be a direct outreach to, let's say, retailers as opposed to going through a normal trade channel. And likewise, there could be many other novel methods being adopted by companies to make sure that customers are served in a timely way. And all of this would ultimately either show up in slightly differing functions being undertaken locally, which would not be happening business as usual, and maybe slightly different risk profile. Now, this will become very important to document because the regular compensation models, benchmarking, and the selection of profit level indicators closely follows the functional analysis. What would follow next is really, let me pick certain transactions in a typical manufacturing setup. The transactions of purchase of raw materials, sale of finished goods or intermediate goods, payment of technology royalty, payment of trademark royalties, and services, headquarter support services, kind of services. Now, which of these transactions will get majorly impacted? One wouldn't know, because I don't think we are yet at a stage where companies are actively renegotiating the price of these intra-group transactions. So what would be really important in my view is that before any renegotiation of these transactions takes place, one would have to see whether that renegotiation itself is something that a third party would ideally do, given the nature of the contract. And therefore the focus on the language or the terms agreed to in the contract will become very relevant, especially given that companies will not be privy to the peculiarities and the contracts of other players in the industry. So it will end up being a very bilateral discussion between specific companies within a group, and to also see whether that change or renegotiation in an intra-group transaction is being carried out across the different group companies, or is it more selective or opportunistic, let's say. And that's really a fact pattern that has to be validated, checked, and tracked closely within a group. And I think right now, why might be a little bit early for companies to say that they have started renegotiation or relooking at those things, because one doesn't know how the situation will really pan out 2 quarters from now, or maybe even 1 quarter from now. Now, given that, how should really one be looking at compensation structures anyhow in advance, or or to kind of doing some forward thinking on how the compensation structure should really be looking? Now, if we are talking about two kinds of manufacturing setups, one could be more a licensed manufacturing or a contract manufacturing setup, the other could be more of an entrepreneurial manufacturing setup. And I think in both of these cases, one would really have to see whether, and keeping in view my earlier comment on how it is being implemented at a group-wide level, one would really have to see that, is there a case for, are we really talking about temporary changes? For example, should a contract manufacturer be continue supplying in a cost plus, let's say 10%, or should the markup be renegotiated from 10 to 5? I would argue that if goods are continue to be supplied, then one would argue against renegotiating the markups. But should the cost base itself be relooked? So rather than looking at a total cost, can one really look at a marginal cost-based approach? So because fixed costs there would be idle capacity getting allocated to the cost base, and would the counterparty or the affiliate in another country be willing to pay for that fixed cost? But again, one would come down to the contract and say, are there volume commitments? What is really renegotiable in a contract? Similarly, and I know it's a discussion that might come later with our other participants, is that for a distribution or a low-risk entity like an LRD or a contract service provider, can one really say that guaranteed margins can no longer be offered in a scenario where there is not enough system profit? And especially basing it on the fact that there is nothing called a zero-risk entity. There is always some risk. It's a low risk, but not necessarily a zero risk. And in an extreme year, when there is no system profit, meaning no group profits at a group or a consolidated level, there is no case for making any payment whatsoever. Again, one could argue against it and for it as well, but one could argue against it by saying that in a good year, when there are the bumper profits, there is no upside being given to a low risk entity. So in an extreme year, can really the downside be shared by a low risk entity? And I think those are issues to think about, because it's not just now an economic problem, it's equally a commercial problem and a contractual problem, and it'll end up being very case specific. I think what I worry about is really that despite doing this beautiful analysis on the industry and on the FAR, everything in my view boils down to benchmarking and what is that magic range. And we know in India that we have two big constraining factors. One, that we must take comparables for the latest year, which are normally never available. We don't have a cycle concept where we can take a 3 years average. Even if we were to, I don't think it would help in this particular situation, because a 3 year average intuitively seems like directionally would be higher than what it would be if you took a COVID year into consideration. And secondly, loss-making comparables are normally not accepted and not found to be very palatable by the tax authorities, especially during the stage of audits. And lastly, we don't have an interquartile range concept yet. We still have a 35th to 65th percentile concept, and that too in cases when a certain number of comparables are chosen in the comparable set. So with this, and anyway, we all know that we will not have 2020 data, to financial year 2021 data at the time when transfer pricing studies are ready to be prepared and filed. So what is the reference point to which we are supposed to benchmark the company's results to? And that would be a big question. In my view, I think this will end up being an exercise done at more a group of nations or at a policy level by tax administrations, where certain relaxations might have to be considered, or else, like Bhumi rightly said, we are in for very heavy high-pitched litigations. I also think on PLIs, one would need to do a rethink in the transfer pricing studies. Of course, very apparently to take out extraordinary costs, one-time costs of obsolescence, write-offs, etc. But equally to very carefully looking at costs that would normally be non-deductible. So to give you an example, in a normal year, the CSR costs, which are non-tax deductible, are not taken out of the operating cost base when, let's say, working out a profit level indicator of EBIT divided by operating costs. So in working out the margins, should the CSR expenses be considered, or the one-time donations that companies are now going to make and are making, should they be excluded? Likewise, in computing operating profit, should one be looking at EBIT or EBITDA? And I think some of this will have to be case specific, but analyzed again to see what is a more appropriate PLI. And maybe multiple methods may have to be used, or multiple PLIs may have to be used, maybe as a primary PLI or a primary analysis and a secondary or comfort analysis as well, to see where they are converging at and are there big differences. Likewise, adjustments will also have to be considered. We know that working capital adjustment has become par for course and is much more readily accepted, although that will also become a very huge thing, because liquidity, we all know in this crisis, is one of the primary concerns among all industry players. And companies which are cash rich versus companies that are on borrowed capital might show very, very different operating results. Also because of the ability to drive changes. I mean, companies that are not very cash rich may not have as much agility in driving changes, repurposing and reconfiguring their network footprint, etc., as companies that are self-sufficient in cash. Idle capacity, of course, again will be a big issue, and adjustments and what is the right way of making that adjustment will have to be worked out, because here both the tested party and the comparable results are going to be somewhat convoluted, and data, like we rightly said, is not available. So what is the kind of safe harbor one can use for these kind of adjustments will have to be a debate and discussion. I think net, and I know that I probably need to stop very soon to have the other panelists talk. I do think that there are no right answers now. There are some thinking points as I've just laid out. And in my view as a corporate, there will be two primary things. One will be amply demonstrating that the price of the intra-group transactions, a sale, purchase, or a service transaction, is not driving the change in profitability necessarily, and there are other factors, conjoined factors at play as well. If there is a big drop in the export price, or there is a big spike in the import price of materials from the related party, then it has to be adequately researched and documented and related back to a COVID situation rather than just attributed to COVID in a more generic way. Secondly, any renegotiations have to be demonstrated with the reference not just to the Indian transactions, but also transactions of that affiliate with other group entities, to show that this was not a one-off thing that was undertaken with a one-off jurisdiction. And I think these will be two mantras. I think rewriting transfer pricing policy because of COVID is not necessarily going to happen, because most groups do recognize it to be a phenomenon which is going to be there for a while. I mean, I don't know for how long, while being a few months to or a year, but it is just something where we would also keep a watch out for whether OECD comes out for any guidance or to which tax authorities, jurisdictions can adopt, which is not yet there. But I think that would also help in kind of creating certain persuasive, acceptance, or at least acceptance of certain approaches that taxpayers may undertake in a jurisdiction. With that, I would like to, I think those are my thoughts that I've just laid down. With that, I would like to pause and see whether, Bomi, how you would like to conduct the rest of it, or, I mean, do I have more time, or should we just move on to the next panelist?
Yeah, so thank you, Shikha. So over to you, Vijayashree, for your views, particularly from the service industry side which you belong to.
Thank you very much, Bomi, and thank you, Shikha, for setting the tone, and Bomi as well. And thank you for the very elaborate thoughts, and some of it do overlap with our industry as well, definitely from a TP side. Okay, so yes, this COVID-19 is kind of said as a black swan event, and definitely it has impacted businesses, economies, human lives, and also, of course, it has impacted TP practices worldwide, looking at the TP policies or benchmarking or documentation for businesses. Now, our organization, or my organization, is also one of the deeply impacted and more visibly impacted businesses with an uncertain future. There is a significant dip in our revenues and also a dent in our future forecasts. For us at this time, cash and liquidity management, yes, is one of the core focus area, and the group transfer
Hi, Vijayashree, if I may, sorry, but could I just interrupt you? I think we lost her voice.
Priyanka?
Yes, I'm just trying to reach her.
Yeah, so you reach her, otherwise I think we'll have to go ahead with the next things. I think, let me carry on. I think you just disconnect her. Please disconnect her.
Yes.
I think we can continue with the questions then. You can reach out to her. If her connection is restored, then maybe we can ask her to just speak, but just check. Vijayashree, is your connection restored?
I think we can go ahead with the questions. Meanwhile, let us sort her issue out and we can come back to her later.
Okay, fine. So I think let me start with the questions. My first, I think you'll have to remove Vijayashree from the screen because I don't think we are able to hear her. Yeah. My first question is to Neeraj Jain and Kevin. So as you heard Shikha also, she talked about the industries. Just one example, she said that instead of taking into consideration fixed costs, we may take into consideration marginal costs. So, you know, not only India, but even similar jurisdictions across the world, you may find that data of external comparables may not be easily available to reflect the pandemic impact on the margins. Now, how do we do the benchmarking in such a scenario? And do you think that this is an opportunity to adopt a different transfer pricing method altogether? Neeraj? Neeraj, you are not audible.
Yeah. Yeah. Now, am I audible now?
Yes.
So, as we know, so far as transfer pricing is concerned, it is all about determining the arm's length price. And arm's length price, for determining the arm's length price, comparability is the cardinal principle, and the price is to be determined applying a particular specified method, which is prescribed in the transfer pricing regulation. But at the same time, the transfer pricing regulation or transfer pricing methodology as such has inherent flexibility while application of for undertaking the benchmarking analysis. So when you undergo or determine a arm's length price of a particular transaction, one has to undertake a far analysis. One has to undertake analysis and analysis of the business and economic environment, and one has to take into account these external factors while determining the arm's length price. And there is always a scope for making appropriate adjustment or selecting a particular method which may be suitable, having regard to the nature and class of the transaction, class of the parties, and the functions performed, etc., etc., and also, of course, availability of data. So having regard to these factors, one would select the appropriate method for undertaking the benchmarking analysis. And on top of it, it is always possible to make adjustment or comparability adjustment to take into account the various factors which are present in the business or economic environment. So having said this, what in the present scenario, in the case of COVID, it is not really it would always still be possible, even if there may be lack of data, the data may not be perfect, it may still be possible to undertake a benchmarking analysis and determine the arm's length price of a international transaction which is undertaken between the two related parties. So as I was saying that choice of a particular method is usually under transfer pricing is not dictated by the change in the economic environment. Choice of a particular method for determining the arm's length price would be depending upon the nature and class or the function surrounding that transaction or the parties are entering into the transaction. And as such, the present environment, economic, which may have hugely impacted the economic environment, may not may be basically determining the which method would be the right method. Of course, availability of data, etc., would be a relevant factor. When I say this, when a particular method, say for instance, the two transacting parties, when they apply, for instance, a profit method, and they do not apply a particular direct or cup method, direct method, which is say for instance cup method, that is for want of a comparable comparable data of the comparable uncontrolled transactions. So the selection of method basically is dependent upon the circumstances or nature or class of the transaction, or and not of the business or economic environment. Now, in the present environment, when a profit method is to be applied for undertaking the benchmarking analysis, and the data of the comparable uncontrolled transaction of the current financial year, where may not be available, which so as to facilitate comparison of like with like, the parties undertaking the transfer pricing benchmarking analysis, in my opinion, would have two options, or two possible approaches. One is to determine the right margin of the tested party itself. So one can opt for normalizing the profit margin of the tested party itself, whereby the abnormal expenditure or abnormal period of operations during this exceptional extraordinary period are ironed out, and one takes into account the profit margin or operating profit margin of the normalized operating profit margin. So that is one way, one approach which is possible for a taxpayer for undertaking the benchmarking analysis. Another possibility is to undertake a comparability adjustment in the data of the comparable companies. So as OECD has also in fact guided or recommended that in case of for determining the net operating profit margin of comparable company of the tested party for undertaking benchmarking analysis, it is possible to exclude extraordinary items for extraordinary items of expense or expenses, etc. Similar guidance has been provided by the Institute of Chartered Accountants of India, and also in the safe harbor rules, the definition of operating expense or operating profit margin provide for excluding extraordinary item of expense. In fact, so what I was trying to say is that it would be possible, the first recourse that a taxpayer should consider is normalizing the profit margin itself and excluding the abnormal period of operation. This, in fact, courts have in fact also accepted in some cases. In fact, I remember one case which we represented, which Mr. Vora in fact argued before the Delhi bench of the tribunal. The tribunal accepted the normalized operating profit margin of the tested party for undertaking the benchmarking analysis, excluding the operations related to extraordinary period. Now, the another item of concern that could be is that for undertaking the benchmarking analysis, while the profit margin or the data of the tested party is taken for the single year, for that very year, which may have been affected by way of the current situation of COVID, and that may, for that reason, would be substantially suppressed. And when you undertake the benchmarking analysis and take the comparable under the transfer pricing rules, now multiple year data is to be taken. So multiple year data, when you take the data of the comparables of the current year, and you take the past 2 years data as well, and you take the weighted average margin. Now, while the current year data may be available of the comparable company may be available, and it may not be available, the past year data which of the comparable that we would have, or which a taxpayer would be able to obtain from the databases, that would be a data of the normal year of operation. So that would not reflect any effect such as of the COVID or lockdown that we are seeing now. So that would in fact be a data of a 2 years data of normal year of operation, and that way, when the average profit margin of the comparable companies would be arrived at, that would be to some extent skewed to, upward, and it would show a higher average margin. So in my opinion, it would be possible for the companies when it is faced with such kind of a data and multiple years data, weighted average of multiple year data is to be worked out, to undertake comparability adjustment in the data profit margin of the comparable companies, to adjust the normal operating profit margin of the past 2 years, and to take into account the factor to prevalent situation. So the comparability adjustment need to be carried out in the comparables data of past 2 years to arrive at a normal operating profit margin. So on that, in the end, when one can do the benchmarking analysis, even in the present scenario, by making appropriate adjustment in the profit margin of the comparable of the tested party or the comparable companies, it would also be recommended for the companies to undertake or seek a review of the advanced pricing agreements which they may have entered into with the government.
We will take the advanced pricing agreements later. So I think you can stop at this.
Yes,
we have got the message from you. So Kevin, I think what Neeraj said is correct. The comparables will ultimately be available, but the challenge really is that on today's date, you don't have a similar comparable. Now, Neeraj gave one solution, that you make the adjustment. So that is one of the solutions. But is there any other solution for an immediate thing which the client should do in the current year? And that multiple data adjustments, do you agree with Neeraj? Because the multiple data, year data which you take, those will not be reflective of this peculiar problem which we are facing in the current year. So what are your views around all that Neeraj has said, and would you do something in a similar manner, or would you undertake it differently?
Sure, and this is a great question. As Neeraj says, you have just some limited choices. Either you make adjustments to existing data from prior years, or you try to look for some leading indicators of what the data is likely to be. Now, we've done some analysis that shows, excuse me, even for Q1 of 2020, you're seeing dramatic drops in profitability. What's really going on here with the COVID crisis is a dramatic change in market conditions. And so this should be, one would think, a universal phenomenon. But the choices theoretically are, you either make adjustments like Neeraj and others were saying to existing data from prior years, you use partial year data and extrapolate it to the extent that the partial year data is starting to show some leading indication of what the full year is going to be. Or you take data from prior known recessionary periods. Of course, we're in an unprecedented time period, so there's nothing really that's as comparable. The closest thing would be the financial crisis of 2008 and 2009. But those are basically the theoretical options. Of course, and I'm glad we're doing this in the context of your law firm here, because this is really, transfer pricing is all going to be about pre-litigating your position. And it's not simply that the data are going to speak for themselves, okay? So you're going to have to present the data in a way that's closely tied to the taxpayer's operations and really build a persuasive case that the two are aligned, and that there may be adjustments that have to be needed. But I agree with Neeraj, you have some limited choices. It all comes down to the details. And that's, I think, where the real key lies, is how clever one is in terms of building the connection between the comparables you're using to define a referenceable range, and then the facts of the taxpayer.
Thanks, Kevin. So Vijayashree, I will be coming back to you, but before that, I will just ask a question to Mr. Ajay Bora. Mr. Voda, we have quite a few clients who are captive service providers to international companies, and they are operating on cost plus basis. So basically, the Indian entity is a risk immune entity. And presently, in this pandemic time, the Indian entity is incurring the fixed costs, but it is not rendering the same level of services to the international entity, or is rendering no service at all. Now, during the period when it is not rendering the same level of services or no service at all, is it okay for the international company not to pick up either the full cost or the pro rata cost? And of course, if it doesn't pick up the cost, there is no question of adding any margin to that. Do you think that this will work, or do you think that this is a risky proposition? Any precautions which one needs to take if one wants to adopt the approach of not picking up the costs during the pandemic period?
I think, Bhomi, as you very rightly mentioned in your opening remarks, transfer pricing is really an issue that is giving rise to substantial tax disputes, because between the tax gatherer and the taxpayer, there is always a difference of the business model, the economics of the model, and so on and so forth. Now, in your example, if I may illustrate the point, the entire globe is under a lockdown. I am assuming that the AE is also under a lockdown situation. The Indian associated enterprise is also not in a position to render service. Now, in that situation, merely because there is a contract for a cost plus arrangement, is it fair to say that that cost of the for the period that the employees at the Indian end are not able to render services and no services are demanded by the foreign entity should also be reimbursed by the foreign entity? And as you said, of course, you forget the margin. Or look at a situation where offices have opened and the government has put a restriction that only 33% staff can attend the office. Now, this is a situation which is peculiar to the service provider. There is no restriction at the end of the service recipient in terms of receiving the service. Now, in this kind of arrangement, you can build arguments to say that this cost, which is being incurred by the Indian entity in order to retain people in employment, whether that should be actually reimbursed by the foreign AE. To my mind, one can argue that this is an abnormal cost, an extraordinary circumstance, an unanticipated or unforeseen situation, and therefore this cost need not necessarily be reimbursed by the foreign entity. Having said that, I would take it that the Indian revenue would certainly dispute this position, and they would say that since your arrangement is a cost plus, this is a cost that is incurred by the Indian entity, therefore this cost needed to be reimbursed by the overseas entity. As I think Shikha also mentioned, you may need adjustment to the cost base. You may need to take out the extraordinary expenses or the extraordinary costs that are incurred in this scenario. And therefore, my view would be, one, when you look at a cost plus arrangement, you can have two kinds of adjustments. One is the adjustment in the cost base. And second, when you look at the margin of the comparables, and if you pick up the comparables here, they would be also suffering a similar fate. The comparables will also, who are providing similar kind of service, would also be constrained and handicapped in providing the service, and therefore their margins will also be affected. So therefore, I would think that both in terms of the adjustment to the cost, as also to then adjustment to the margin will certainly be required. Further, you will also need to look at the overall profit that is earned by the foreign associated enterprise in this arrangement. They would also be suffering losses. Now, it would be unfair to say that because the foreign enterprise has, notwithstanding it has suffered a loss, it still needs to compensate the Indian entity on a cost plus arrangement. Now, clearly, this is not black and white. These are matters of argument, these are matters of detail, and I think extraordinary situations require extraordinary presentation and extraordinary arguments. And I'm sure this will cut ice with the courts to see it in a judicious manner. That's how I feel it. And Neeraj gave you the example where we had this sealing drive in Delhi, and the office was sealed. And the Indian enterprise had to move to a different office. There was a time lag of 2 to 3 months. There were costs incurred in moving. And it was a cost plus arrangement where the tribunal made the necessary adjustment that was required in order that the data was comparable, which was upheld by the High Court. In another situation, the tribunal ruled against us on the first point, saying that there was a bench strength and the Indian entity could not use effectively the employees that were on rolls, and we therefore claimed that this cost should be excluded, which the tribunal did not agree, because they said that the employees were taken by the Indian entity on its rolls only at the bidding of the foreign enterprise, but they accepted the adjustment on account of underutilization of capacity. So it will be a fact-driven situation, and I think it is possible to argue that an adjustment to the cost base or an adjustment to the margin is called for in this extraordinary situation due to the pandemic. That's how I would do it.
Thank you, and thank you for saving a question from me, because I was going to answer, taking a cue from Shikha, that what happens if the overall situation is a loss at the group level, and you have addressed that. So thank you for that. So I think I will ask one question to Marie-Claire right now, and then I hope Vijayshree's mic functions well. And Priyanka, while Vijayashree is making a presentation, I would request you to show up on the screen. So Marie-Claire, the question to you is that, again, this is a live question of one of our Indian clients, and we want to see how you would have dealt with the situation in Europe. So this Indian client is a limited risk distributor, and he's operating on cost-plus basis. And the question is that, as a matter of right, whether one needs to continue to pay the guaranteed net margins to the limited risk distributors. Keep it in mind that the operations of the limited risk distributors have been restricted because of the disruption caused by the pandemic, and whether the principal would be still required to compensate the full fixed cost of the limited risk distributor during the lockdown period.
I mean, in Europe, wouldn't be different from what we already said. I mean, the speakers, they already comment on that. So in Europe, wouldn't be different. So first of all, as Shikha said, we should enter into a possible renegotiation of the agreement. So understanding if the contract may give room for revisiting the relationship, or there might be any clause regarding force majeure. And, right now, during this time, COVID-19, a lot of force majeure clause from a legal perspective have been, used in terms of finding the way to revisit the clause. So back to your question, I guess during this time where losses would be the ultimate result in more group and more companies, we believe right now, I guess it's necessary to rethink the business model before doing any change to the transfer pricing. And since before doing that, we need to think if this kind of change is on a temporary basis or not. Another point that we should think, and this is quite common in Europe, that will be attacked by the tax authority, is you need to make a distinction between your shareholder function distinctive from a related party transaction. Since if you have a company subsidiary in a loss position, you can cover or enhance or restore the losses in a different way through capital contribution instead of changing the rules or the TP policy. So, I mean, the analysis should be done clearly on the situation to see if the market would be a fact for a long-lasting situation. So in this case, you need to change probably your agreement and also your business model, and you need to revisit your functional analysis, but you cannot change your transfer pricing overnight. I mean, COVID-19 is not overnight, but we need to ground the change. So guarantee is not the right way to move forward, since, as I mentioned, the loss can be covered by the group through a capital contribution. And, any guarantee situation may lead to potential litigation as outlined before.
Right. So this is a very strong message. Do not change the transfer pricing methodology overnight. So with this, I think, can I just request Vijayashree, is your mic functioning well? We are still not able to hear her. Priyanka?
Yeah. Am I audible now?
Yeah. You are audible. So can you in just about 10 to 13 minutes tell us what issues you are facing and what are the strategies you are adopted?
Yes, please. Sorry. So sorry for the technical issue. This is apart from this we need to face apart from the transfer pricing challenges now in the new normal. Okay. Anyway, coming back to where I left, I don't know where I stopped, but then we operate as a captive. Can you hear me? Can you hear?
Yeah, we didn't hear anything in your first presentation. So you can start.
Okay, fine, no problem. Actually, most of it is being covered by Ajay and Shikha, and I think I will just supplement many of the strategies or what are the issues we are facing, and it should be nothing different than what they've already spoken. But yes, to start with, yes, it is a very unprecedented situation for us. Our business is one of the, or our organization is one of the visibly and deeply impacted. Business with an uncertain future. We have a deep dip in our existing revenues, and also in terms of our forecast, there is a major dent. There's a lot of uncertainty. Now, cash and liquidity management is one of the core topic that is centered around this scenario, and transfer pricing policies and also the measures that we take as an organization is also somewhere linked there, and that's one of the important topic that we are relooking at. We are set up as a captive service provider here with a limited, with a cost plus margin from our principal parent. Ajay rightly said that as a parent also the contracts are on hold today. Apart from the local service providers not being able to perform those contracts on ground because of the lockdown, and also there is no market, so to say. The projects are on hold. So there in this kind of situation where the parent itself is having a liquidity issue and a loss situation, do you have to, it's really sounds worthwhile, or there is a merit in exploring whether the losses should be shared between the parties during the period, or the margin should be lower, or only the cost should be reimbursed. So this is, I think, we find merit, because transfer pricing at the end of the day always needs to be adjusted to business realities. So if the business realities are saying something else, then definitely we have to kind of be mindful of that. That's one of the perspective. The other aspect is we are looking at segment wise. So we can't look at as one view for all the segments. So whether it is intercompany royalty arrangements or a sub-management cost recharge arrangement or the cost plus business contracts, each segment has to be seen differently on how do we approach. And within the services segment also, we are kind of breaking it down to see in terms of functions. So that's one of the things that we're looking at. As an immediate step for financial year 19-20 that we are trying to address is the approximately 6 weeks issues that we faced until March 31st, and whether there's a possibility to lower down the markup, say by 1 or 2% to capture that effect. So that's one thing, is an immediate measure that we are looking at. Second is financial year 2021. Now this topic, we are exploring different things. Now one is, of course, margin, lowering the margin. That's very obvious. Now comparables. Now quality of the comparables is an issue for us. We are in a unique business. What is the comparable, and whether the right comparables are being used? Now every business is unique, as Shikha also pointed out. So what are the new, and new quantitative and qualitative filters that we need to adopt to reflect the economic situation. That's one of the aspects when we are looking at a comparable scenario. Now, somewhere the margin around the lower end of the 35th percentile is one of the approach that we are looking at. And also cost-based calibration, very important, and the adjustments on account of underutilization of capacity, which is already pointed out, possible severance payments or contractual defaults or penalties. And of course, the extraordinary expenses adjustment on account of that. Now, all this we are looking at normalizing the profits during this period. Nothing different than other speakers who have just highlighted. And one other aspect which is very different that we are thinking of is, why don't we look at a different model? Can we look at a revenue-based model versus a cost plus? But yes, this is very, very litigative topic. We have to kind of, we have to look at the long-term scenario and how it will be defendable with the business justification, commercial rationale. But this is something we are exploring, so that because that's the right way to measure a profit of an entity based on applicant counts or the applicants who are visiting our visa application centers. So that's something different that we're doing on. And yes, we are mindful of the fact that we are operating globally under similar arrangements and which has a different kind of cost plus. That's something we have to be aligned to. And also documenting in our master file is very critical. So documentation is a key here. It has to be made as contemporaneous as the situation permits, by way of, say, minutes of calls, or say CEO updates, or say any, of course, intercompany agreements need to be changed, exchange of letters. So I'm quantifying the extraordinary costs, then making necessary changes in the financial systems or financial statements, and of course the transfer pricing study. These are some of the pointers on the documentation side also we are focusing on. One good point that that came up during this is also on the management cost recharge. Now, considering the liquidity situation and the loss position in most of our subsidiaries, now we were considering whether a moratorium could be considered by the parent entity. Now, what we do internally in our organization is we adopt local revenues as the key for allocating management costs, followed by a charge which is based on profitability of those entities. Now, because of the loss situation in most of the entities and the cost being allocated to a fewer entities in that formula, it becomes a bit of a skewed and a inconsistent cost recharge. So that's one more challenge that we are facing in a management cost recharge, which made us think on why don't we seek a moratorium by the parent, and we will kind of revisit on a quarterly basis. Now, for all our transfer pricing policies, what we are taking a step is we are going to review that on a quarterly basis, take positions on a quarterly basis, as long as the COVID situation, the way it comes out. So and another point is, yes, in the management costs bucket, whether those can be seen as a stewardship, or whether that is rechargeable, because during this time, whatever services are provided by the management, whether it is akin to a shareholder activity or whether it can be recharged, that's another important aspect as well. Now, on the royalty bit, what we're doing is our royalties for to be paid by, to be charged by the IP owner is based on local revenues. Now, the local revenues, obviously, there's a dip in revenues due to whatever reasons on impossibility of performance. Now, this affects the charge automatically. But what we have done is we have deferred the charge for this quarter, and we will revisit again in July for the, and all these adjustments are going to happen during the year. So therefore, it should not affect transfer pricing for the year if you're looking at. So I think adjustments during the year on a quarterly review basis should be a kind of approach that we are looking at. And in summary, I would like to end, by saying that in this new normal kind of a scenario, where there is a need to recalibrate the pricing of the intra-group transactions, I think we should do it within the line of the defense, and with the consistency across all group entities, and also proactively preparing ourselves to meet the challenges expected to be posed by the transfer pricing authorities in future. I think that's the key message from my side. Thank you.
I think a very strong message from your side that you can't just shift from one approach to another, as you said, from cost plus to a revenue-based model. There has to be consistency, and it should work for you for a long term. You did mention about the deferral of management fee, but there are instances when people are even talking about waivers. But I think because of the shortage of time, I will not take this topic at the moment, but I would just pose a question to you, Priyanka, and then maybe you can move on to your sessions 2 and 3. So as per my knowledge, there are about 300 approximately APAs with the Indian government. Now they were entered into taking into consideration the economic scenario at that particular point of time. Now, can the multinational enterprises seek a review of APAs for downward revision of these prices, margins, considering the changed economic scenario because of COVID-19?
So I think APAs have actually been a very effective tool to dictate the arm's length price and to reduce the tax transfer pricing disputes for taxpayers. But with the present pandemic and the economic conditions, the companies are unwilling to pay the pre-decided prices. And in fact, a lot of our clients who are multinationals and particularly captive service providers are reaching out to us for legal opinions as to how they can exit an APA or renegotiate a concluded APA. So for this, I think the answer is yes, the Indian tax laws do provide for revision of negotiated APAs. The taxpayer has to present a case for revision and opt to revise the APA by carrying out negotiations with the tax authorities. Now, this approach is also consistent with the OECD guidelines on transfer pricing, which recommends that APA should include the flexibility to account for significant and uncontrolled changes in economic circumstances. Now, most APAs have a critical assumption of the business environment being normal through the term of the APA, but Rule 10Q of the income tax rules provide that an APA can be revised if inter alia there is a change in the underlying critical assumptions. So, in short, the point is that if the taxpayers need to approach the tax authorities for presenting a case for revision, and in case if the tax authorities do not agree for revision, maybe we can look potentially at a request for cancellation of the agreement. Now there is also option for the tax authorities, the APA authority, to cancel the agreement suo moto if they think that there has been some failure on the part of the taxpayer to comply with the terms. So probably in case if there is such a situation arising, because there'll be a lot of failures by a lot of people in complying with the critical conditions of APA. In that case, the taxpayer could even utilize this opportunity provided to it to explain the pandemic related impact on the APA and maybe even justify the reasons for its failure to comply with the terms. And apart from that, I think we can also look at those people who are in the process of negotiating their APAs. In those cases, since business impact is very uncertain right now, it may be prudent to wait and watch to get a better clarity regarding the full impact of the pandemic before you conclude the APA. Alternatively, you can agree for a APA for a shorter term, maybe for financial year 2021, and then apply for another APA after that based on the evolving scenario. I think that is about unilateral APAs. For bilateral or multilateral APAs, you will also additionally require the consent of the applicable treaty partner, and they need to agree to the revision which are proposed by you. Now, since APA is, a relatively new phenomena in India, we do not have too much guidance how to deal with such a novel situation. But probably we can take a little guidance from the other countries' administration of APAs, which has happened during the prior recession times. Like for instance, in 2008, the US APA authorities have agreed, and they have in fact considered certain adjustments to the APA proposal to give effect to the impacts of downturn on the industries. So this is for us to all wait and watch and see how the negotiations take place. But I have learned that the commissioners of APA in India, they have been proactive and quite receptive to coming back to the table and rethinking the terms of APA. Of course, like everybody else, they are also conscious of the economic distress which everybody is facing. And they have been suo moto approaching the APA assessees who have already concluded APAs to come out with some kind of a mutual revision which is acceptable to both the parties. And while you come to a conclusion for revision of APAs, I think I echo what Shikha said, that given the diverse impacts on each businesses, one size fit all approach cannot be adopted by the APA authorities. So you cannot have revisions, blanket revisions across the APAs, because every industry, or in fact every business within an industry, is being impacted uniquely, and that unique challenges need to be considered and be in mind while we renegotiate our APAs.
Priyanka, I told you to carry on with your sections 2 and 3.
Okay, so we can finish off with the transfer pricing aspect and move on to the next challenges in international tax, which is being posed, during this pandemic lockdown. So I think before we move on to the next section, I would like to quickly summarize maybe the key takeaways which we had from this transfer pricing discussions, and what at least I personally have the key takeaways, that if we need to do an impact assessment as to what effects it has on our financial results and also the capital structures. We need to talk with the tax authorities for revision of APAs and mutual consensus. And of course, the stress on documentation cannot be emphasized more. It is the important key. And that is, we need to maintain a contemporaneous documentation, because the tax audits would happen 3 to 4 years down the line, which we may not actually recall the circumstances or the minutes of the meetings which had happened at this point in time. So I think we have only scratched the back of this incredibly complex topic, and there are a lot of nuances, a lot of novel issues which are arising, which probably we as tax advisors will need to deal with day in, day out, and will keep us busy in the coming time. But now, without wasting more time, I think I can move on to the next section. I think I will start with Mr. Ajay Vora. And in today's time, I mean, of course, previously home was the place where we would crave for after a hard day's work. But now it seems home is the new workspace. Now this is the time when working from home is the new normal, and the culture of remote working and remote teams is getting accelerated significantly. So this makes us wonder whether the comfort of home could trigger any tax issues, like for example establishing a home office PE from a double taxation avoidance agreement perspective.
See, basically, I think, as you are aware, in order that there is a permanent establishment, there must be a fixed place available at the disposal of the enterprise, through which the business of the enterprise is carried on. So I think you are talking of probably an executive, a traveling executive working from home while he is, locked down. So in that situation, I would tend to take the view that you have to decide whether this is a place available to his employer, whether it can be said to be at the disposal of the employer, and the nature of work that the employee is carrying on. Is it the core business activity of that enterprise? Because the Delhi High Court, in the case of e-funds, and which was approved later by the Supreme Court, emphasized that the activities through which business is carried on amounts to core activities. So the nature of job that this particular employee is doing from home while he's on travel to one jurisdiction or while from his home in another jurisdiction. I think that will depend on the facts of these cases, and you have to then determine whether one can say that his employer has constant use of this space. This space is available to the employer in order that it can constitute a fixed place PE. And I have this OECD Model Convention of 2019, which explains in para 18 that even though part of business of an enterprise may be carried out at a location such as an individual's home office, that should not lead to a conclusion that location is at the disposal of that enterprise, because the location is used by an individual who works for the enterprise. So basically it is fact driven, but this is the commentary that is there issued by OECD. And then in a reverse situation, the authority for advanced ruling took an adverse view, again based on the facts that the residential address of the country manager was held to constitute a fixed place PE for the foreign enterprise. Now again, based on what was actually being done with reference to that particular home office by the country manager of that foreign enterprise. Lately, this is a report of April 2020 issued by the OECD, Secretariat Analysis of Tax Treaties and the impact of the COVID-19 crisis. Now they have summed it up beautifully, having regard to the exigencies of people being locked down, having forcible stay in a country other than their place of work. And they say, and I quote, during the COVID-19 crisis, individuals who stay at home to work remotely are typically doing so as a result of government directives. It is force majeure, not an enterprise requirement. Therefore, considering the extraordinary nature of the COVID-19 crisis, and to the extent that it does not become the new norm over time, teleworking from home, that is the home office, would not create a PE for the business employer, either because such activity lacks a sufficient degree of permanency or continuity, or because except to that one employee, the enterprise has no access or control over the home office. In addition, it provides an office which in normal circumstances is available to its employees. And pursuant to this OECD guidance, many countries such as New Zealand, Ireland, Australia, Canada, Singapore, Malaysia have clarified that PE of a foreign company will not be constituted in their country due to travel restrictions imposed on account of COVID-19 pandemic. So I hope that answers your point that merely because that employee is working from a home office, that would not result in a fixed place PE unless facts warrant a different conclusion.
Okay. So in a sense, I think what the principle is laid down is that, of course, there has to be a certain degree of continuity or permanency, and the the home office should be at the disposal of the enterprise to constitute a fixed place PE.
That's right.
So I think taking a cue from that, that talks about fixed place PE. Now, in cases of agency PE, like if we take the same example in which we have an Indian citizen who is an employee in a foreign company, and he has traveled back to India due to holidays or maybe otherwise, and now due to the suspension of travel and lockdown, he is stranded in India. In the meanwhile, maybe he is approached by one of the potential customers of his employer with a business proposal. Now, because of the lockdown situations and because of the reasons that there cannot be a physical transmission of the documents, can he accept the same proposal on behalf of the foreign company and maybe sign the contract as a representative of his employer? Or in fact, now with the BEPS and BEPS action plan being into place from 1st April 2020, even playing a principal role in conclusion of contracts creates an agency PE exposure. Now, as I understand that, yes, this is also a subjective test which are driven by facts and circumstances of the case. But in your view, what are the legal conditions which can be laid down broadly?
You see, a dependent agency PE, broadly speaking, in terms of Article 5.5 of the OECD Model Convention, requires that there is a dependent agent who has the authority to conclude contracts on behalf of the enterprise of whom he is an agent, and he habitually exercises such authority. Now, in this particular scenario, he is an employee of the foreign enterprise, so let's assume he is an agent. and he is dependent on the enterprise because he's an employee of that company. That is, basis of livelihood. That is his remuneration. Now the question is whether A, he has authority to conclude contracts, and B, whether he actually exercises such authority. So again, as you very rightly pointed out, this will be fact driven. Now we have to see that does he have the authority to conclude contracts? Can he on his own take a decision to sign enter into a contract with that potential customer? Or does he have to revert back to his employer company, and the employer company, tells him whether or not to accept or to reject the particular contract? So whether he is merely acting on the directions and is acting as a signing authority, is only a stamping authority, in which case one can say he does not have the authority to conclude contract. But if he on his own, as a whole soul person, can take that decision to accept the contract, yes, you can possibly say he has authority to conclude contract. And then you have to see the further limb, whether he habitually exercises such authority. So the number of instances where this individual would have accepted contracts on behalf of his foreign enterprise would again determine whether or not one can say that he habitually exercises such authority. So I think those possibly parameters will need to be demonstrated before he can be construed as a dependent agency PE.
I think a different approach maybe is warranted in case if before the COVID-19 crisis, he was in fact actually exercising the conclusion of contracts habitually, or he was principally concluding the contracts. So we need to historically see whether those authorities were available to him before the COVID crisis, and primarily not only because not with the advent of COVID that he has exercised this authority.
I think the other point, it's an interesting issue that you've raised. Now he is an employee of a foreign company based in that foreign jurisdiction. Now, like you said, he was habitually used to exercising authority in the foreign country while he was there of accepting contracts. Now, when he comes into India and he is locked down here, now in that situation, does he become an agent? I'm assuming he's not a resident of India.
Yes.
He is on travel. Now, those dimensions will also have to be gone into that. Here is a person of the same organization traveling to a different jurisdiction, accepting a contract. Does he become a dependent agent who is a resident of the other country? So I think that question will also need to be answered. And to my mind, if he is not a resident of India and he's here on travel and he's locked down here, I don't think you can call him a dependent agent present in the other country so as to constitute a dependent agency PE.
Right, sir. Okay. I think, Marikla, if you have any inputs on both the issues about home office PE and agency PE from perspective of the European jurisdiction and your double tax avoidance agreements.
I mean, I can't add anything else what has been already said by Mr. Vora, since actually here we are talking about principle and also clarification made by OECD with the guidelines issue April the 3rd. So, I mean, the combination of the two lead to the same conditions and conclusion. But one thing is always important, and the strong message here, in any case, we need to analyze on a factual basis what may happen, not during the lockdown, but immediately after, when the new normal be in. If there might be habitually someone that is contracting on behalf of the company, doesn't matter if you were there for lockdown perspective, but if you continue on a temporary, not on a temporary basis, but you are consistent what you're doing, that might be an issue. So regardless, you're there for lockdown 2 months before. So actually, you need to analyze from substantial point of view what you did, from agency PE perspective, as well as from a resident perspective, and regarding the employee the example you made as a first. So analysis should be done on not only from contractual point of view, but what is doing actually.
Yeah. So I think it's all a fact-driven exercise and an analysis, and the answer is only dependent on a case-by-case basis. We cannot have a universal answer to the problems. Absolutely. So I think moving on to the next classification of PE, Neeraj, Mr. Neeraj Jain, if I may ask your inputs regarding construction or building site PE. So under the DTAA's, the building site or construction PE is constituted only if it lasts for more than 12 months, and in fact in few DTAA's it's even a lesser period. So due to this lockdown, the construction or installation activities have been suspended or terminated. Now I think there has been judicial precedents which have allowed such exclusions of unusual temporary suspensions. But of course, COVID-19 is giving rise to novel issues and hence novel arguments. So what is your view that in case if the construction project undertaken is temporarily interrupted, maybe due to the lockdown or due to invocation of a force majeure clause, can the revenue authorities still question the number of days in India and allege a construction PE?
Actually, so far as construction PE is concerned, the general rule or accepted principle is that seasonal or temporary interruptions or usual interruptions are not normally taken into account, are not normally excluded for determining the life of the project or contract. Now, this is what OECD says, and this is what Klaus Vogel in his commentary has said, that interruptions which are in the normal course need not be excluded. Now, as you have rightly pointed out, Bombay Tribunal in one case has in fact taken these principles into account, and here it has said that certain interruptions would otherwise not be excluded, and while computing the life of the project. Now, in one case, the Federal Tax Court of Munich, in case of IBFD, in an IBFD's case, however, has disregarded an interruption which was caused by the action of the client, of the contractor. So this was not within the control of the client, and the interruption was disregarded on the basis that it was for unusually large duration, and it was if it were to be for a lesser period, say for 2 weeks, the judgment says the interruption need not be excluded. Now, OECD in its report dated 3rd of April 2020, however, for the dealing with the COVID crisis, however, considered this situation to be a temporary interruption, and for that reason, the OECD report says that since a duration test for a construction contract usually is for 12 months or 6 months, and this is only a temporary interruption, so it need not be excluded while determining the life of the construction contract or project. Frankly speaking, in my personal opinion, the OECD's recommendation could have been somewhat different, because this situation, one, it is unusual and extraordinary, and it is not something which is within the control of the contractor. The situation as such is not within the control of the contractor. It is a long term, it is leading to a long term interruption for more than 2-3 months for executing the project. And for that reason, in my view, there should have been instead a recommendation for excluding this period while determining the life of the project. However, OECD has recommended otherwise.
I think that's a noble thought which you have, which probably OECD needs to reconsider also. Kevin, do you have anything to add to what Mr. Neerajan has just spoken about on the
No, not
OECD
really.
guidelines?
I think this is probably more of an Indian transfer pricing issue, so I would defer to Neeraj.
Okay, all right, thank you. I think it's about time that we can move to the question answers which we have received from the audience. And
Priyanka, can I come in to just supplement to what Neeraj said? You
yes,
see,
absolutely.
notwithstanding, whatever be the recommendation of OECD, of course, it is persuasive in the Indian context, but not binding. You have to see the disruption that has been caused as a result of this COVID-19. The government has stopped all construction activity, labor has moved out, and labor will take time to come back. So even though there are mandates from the government to say that construction can start if the labor is, stationed in-house, you provide them food, you provide them with all the PPE kits and all that, that is not going to work. So I would think that on a practical side, the disruption in the period of time for which the site was suspended will certainly have to be excluded. And I'm sure that the courts will, notwithstanding again the OECD recommendation to the contrary, take this as a permanent disruption and not a short-term suspension of the work. So I would think that as we go along, this will be tested in courts and this will not be added to the period for which the construction site is working in the other country. That's my view.
Yeah, I think that's a fair proposition. I think in the Indian context, I think one can still contend as Mr. Vora is suggesting.
Absolutely. So it is impossibility of performance which guides you whether to exclude that suspension or not. Okay. So I think while Mr. Vora, you are here, I just had a thought while you were speaking, although it is not relating to PE, but could I ask you something to do with the amended rules of residency and the exposure which individuals are facing due to the thresholds being crossed due to the residency requirements? Now, a lot of countries have issued guidelines on to exclusion of those stranded times when they are locked down in a country from the test of residency. Interestingly, India had also issued a CBDT circular to exclude the number of days of stay in India for the previous financial year in case if you were quarantined or there was a suspension of international travel. Now, I think the circular is quite interesting to note that it records that the objective of the circular is to provide relief to the hardships of those persons who intended to maintain the status of non-resident but who were forced to become resident because of the threshold criteria. So even otherwise, do you think that apart from the circular, on a general conceptual basis and on a legal basis, the time period which is beyond your control because of being locked down and where you were forced to stay back in a country should otherwise be excluded while you're calculating the residency test threshold?
Priyanka, basically you go by physical presence for the stipulated number of days. Now, assume you are here on work, you are a non-resident, you are here on work, and you spend the rest of the time traveling or holidaying. That is also counted for purposes of your physical presence and to determine your residential status. Now, here in this case, as you very rightly said, you have to demonstrate your intention to go back in order to preserve your non-resident status. Now, how do you demonstrate that will be the question. That you have a ticket in hand, that you intended to travel, you had an open visa which allowed you to go back to wherever you wanted to go back, or things of that kind. So there was no restriction on your travel, but for this possible stay in India. Now, the Delhi High Court in the case of Suresh Nanda dealt with a similar situation where the gentleman who was a non-resident was forced to stay in India because his passport was impounded. And it subsequently turned out that the case of impounding of passport was frivolous. Now, in that situation, the Delhi High Court said, and the tribunal and the Delhi High Court said, that that period of stay, where he really didn't intend to stay in India, had to be excluded to determine the number of days presence. Now, here again, notwithstanding the circular, assuming the circular was not in place, even in that situation, in my view, you had to show that you were forced to stay in India beyond your wishes, beyond your intention, and therefore that period of stay needed to be excluded. This is not staying back in India of your own volition.
Yes, absolutely. So I think the point message is that notwithstanding the CBDT circular, and more so when the circular has been issued only for the last financial year, we need to await for the next guidelines. But even having said that, on a conceptual basis, on a legal basis, the reading of the act, the time period which is beyond your control needs to be excluded from the test. So I think with that, we could go to the questions which have been posed by the audience to the panelists. And if I may take the first question, which has Mr. Ajay Gora, the first question is directed to you. It's Mr. Sanjeev Goyal, who would like to know that his question is quite long enough, but I'll try to summarize it. He says that a captive unit is providing services to 10 countries and 4 have discontinued. Therefore, the Indian entity is incurring losses. Now, in a cost plus model, how should one justify such loss to avoid primary and secondary adjustment? And I think Shikha and Vijayashree also can supplement after you have given your initial thoughts.
No, I think you need to make the facts more specific. So is it the contract signed by the head office with the Indian service provider to provide services in 10 jurisdictions?
It seems like.
Are there independent contracts with those 10 jurisdictions? So if the 4 have gone out, yes, they have gone out. But if the head office has initially signed the contract that you have to serve 10 jurisdictions and 4 of them have closed, I don't think these agreements are cast in stone. They cannot be divorced from business realities. And I would not see it dehorse what is on the ground. So if 4 jurisdictions have closed down business and your services are no longer required, now in that situation, this will be an adjustment that you need to make to maybe your past results, maybe to the year under consideration. So you had a certain bench strength or you had a certain cost. Now instead of serving 10 jurisdictions, you are serving only 6. But the cost remains the same because you've not fired the employees, you've not cut down on your rentals and so on and so forth. So this will require an adjustment into your cost base. And this will have to be appropriately factored in before you do a comparison.
Right.
Anybody? If you just give me a moment, I would like to state that transfer pricing, according to me, is not a science. It is an art, and it must take into account business realities. It is more economic driven than driven by law. So that I think we need to keep that in mind while attempting a benchmarking exercise.
Yes, and I think that's precisely what the OECD guidelines have been emphasizing always, that arm's length price means what was the realistic opportunities available to the associated enterprise, be it a financial arrangement, be it a management fee arrangement. And basis that you determine what is an arm's length price, irrespective of what is the paper reality.
Sure.
So let me ask one question to Kevin and Marikla. You see, you have heard about the various strategies which are being grappled with. You have heard from various speakers, and you have also heard about the various kinds of adjustments. My question is that in course of your practice, have you come across something interesting which you would like our viewers to know, both in terms of strategies to deal with the transfer pricing issues arising out of COVID, as well as some peculiar adjustments which you have thought about owing to the pandemic. So we would like to hear your views. So Kevin first, and then followed by Marikla.
Sure, that's a very good question, Bomi. Thank you for that. Well, I guess I would frame it this way. As the last speaker just noted, what you have with the COVID pandemic in terms of economic market condition is a downturn in the top line. This causes distortions in ratios that you would normally see under normal conditions. So, for example, if you're a distributor, your SG&A relative to revenue will probably be higher now because revenue is lower. If you're a manufacturer, your fixed asset ratio to revenue is going to be a higher number because revenue is lower. So this causes some distortions. In other words, while the market conditions change drastically and quickly, it's not the case that your operational expenses, your balance sheet can change instantly. There's frictions from an economic standpoint. So this ties together a lot of the comments that have been made previously. One therefore needs to start making adjustments, adjusting the comparables to mimic the circumstances that the taxpayer currently finds himself in. Now, this is an issue that is very fact specific. I can't get into specifics, but just to say that if you're a distributor, if you're a manufacturer, your cost structure is going to be totally distorted, probably. If that's the case, okay, measure it and then figure out how best to mimic that circumstance in the comparable set.
Good. Marikla, do you want to add anything to what Kevin said?
So now you can hear me. I mean, Kevin said the most important things from a transfer pricing. You need to look at and analyze it deeply, the situation where you are, and then take a decision. And I would say the same. And what the clients are doing right now is to analyze if they have to do any change. And as Priyanka said also, they are mapping if there might be any APA in due course already negotiated that should be reopened based on the strategy they're going to change. For the time being, what I would like to highlight, since might be interesting for India, also for inflow and outflow, is the intention of certain group to onshore manufacturing activity, or at least to change, to move from China or other Far East situation in order to have a closer and much more easy way to access the supply chain and the raw materials and the manufacturing in order to be ready in case something may come up again, not having a disruption into the business. So in the next months, I would say the next years, this will affect for sure the global business and the global model in related to the supply chain, the way how being delocated the manufacturing activity around the world. That's what I think might be one of the major change in the future landscape. And so for sure, transfer pricing will be the consequence of it.
Okay, thanks.
Yeah,
Yes, yeah,
if I may,
Neeraj?
yeah, actually, just to on that question of whether a captive service provider, if he is not able to render service during this period, whether the cost can still be recharged. What my take is that in case of the Indian transfer pricing regulations, whether you apply transactional net margin method or a cost plus method, what the cost which you have to consider is the cost incurred in relation to the services which has been rendered, or cost in relation to the international transaction. When the services itself have not been rendered, For instance, in one example, 4 out of 10 contracts got cancelled, and there was no occasion for the service provider to render service. So the international transaction itself does not take place, and there is in absence of such services, and therefore the corresponding cost, to my mind, cannot be loaded or billed while undertaking the benchmarking analysis under transfer price, transactional net margin method, or cost plus method, or otherwise. So that can be one, and that's the reason I've been contending in the beginning that it should be possible for the taxpayer to work out a normalized profit and loss account, whereby, or operating profit margin, whereby this abnormal year of operation, the cost incurred during this abnormal period where the services are not actually rendered, may be excluded from consideration for undertaking the benchmarking analysis.
Okay, Neeraj, thanks very much. I think this captive service provider has been discussed enough, and we only have a few minutes left. So I would request Priyanka, if you could just take on a few other questions, and then we'll have to conclude the session. So can you take the other questions, please?
So this question has come from Ms. Nitika Bagadia, and she is asking that owing to the changed business practices arising because of the universal lockdown, can there be a potential circumstance of dual residency for corporates where POEM may be in a different country while it is resident in a different jurisdiction? So I think before the question is answered, for the benefit of the audience, I can just probably summarize that POEM is basically place of effective management, which determines the residency status of a company other than an Indian company, and this has been effective under the Indian tax laws from 2017 onwards. The place of effective management precisely is where your key management and commercial decisions are, and it is an internationally recognized test for determination of residence of a company. So there could be a situation where a company is incorporated in one jurisdiction while its place of effective management is in another jurisdiction. Hence the question arises about dual residency. So this was just to give you a brief background of what the concept is. If the question is posed to Mr. Ajay Vora, and it can be supplemented by the other panelists.
Priyanka, I would think that assuming dual residency is established in the first instance, in the sense that the company is incorporated in one jurisdiction and has, let us say, management or place of business in the other country, this test of effective management or place of effective management is actually the tiebreaker test. So once you resolve, and it will be only one country which will be the place of effective management. So even between the two competing jurisdictions, you have to decide the place where the effective management is exercised. And that will be the place where the company would be treated as resident. So therefore, according to me, post-POEM, you will not have a situation where you have a dual residency of a company. That's my view.
Probably the tiebreaker test which you are talking about is in terms of the treaties which prescribe the tiebreaker test. But could there be scenarios where India has entered into treaties which does not still prescribe for a tiebreaker test within the treaty?
No, so assume that the company is incorporated, let us say, in a treaty country where you don't have this place of effective management, and it becomes a resident of India on the basis that India is the place where the effective management is located or situated. Now, in that country, India will treat it as a resident of India for Indian tax purposes, and therefore seek to tax that company as a company resident of India, having its residence in India. So all consequences will follow so far as Indian tax jurisdiction is concerned.
Okay, absolutely, sir. Thank you so much. Mr. Daruwala, we can move on. We can take one last question since we have.
Yeah, so you please take it, Priyanka, because I'm not able to see the question panel. Please take it.
Okay. I think the other question is regarding, Merit-Law. Kevin, I think you will have to supplement as to what are the guidelines as far as POEM relaxations have been issued by UKM, HMRC or other European authorities.
Well, I would defer to you, Marikla. This is your area, not mine.
Oh, regarding residents, I mean, apart from the UK, no, we are not, right now in European, let's say, guidelines on that field. Not yet. But, apart from OECD, that would be, the leading guidelines for the time being. The countries are thinking about this, but not a specific issue or direction.
Right. Okay. I think I was recently reading about the US having issued a guideline for the snowbirds. So the Canada migrants who come to US during the summer time and have been stranded there. So a maximum period of 60 days have been excluded from the US tax residency rules. But probably we need to await other jurisdictions to issue similar guidelines before we can actually take some relief out of it. So I think we can, it's about time and we can conclude the session. So thank you everyone for attending the webinar, and for those who could not attend it live today, we shall be sharing you the recorded video link for your later viewing. And thank you so much to all the panelists. It was great hearing your collective thoughts on taxations in times of such distressed economic conditions. And I think my one key takeaway is that, or one positive takeaway, in fact, is probably that there could be gloom and doom generally all around, but for us tax advisors, there's definitely some sunny times ahead. So I think with that, if anybody would like to have a concluding remark before we exit the webinar.
Yeah. May I come in, Priyanka?
Absolutely, sir.
I would just like to react to what Marikla said. With all governments encouraging onshoring of manufacturing, you will have a lot of business restructuring. As an example, assume the Italian company had an associated enterprise in India who was having a long-term contract manufacturing arrangement, and they decide to take it back to Italy. Now you will be making termination payments, or you change full risk distributor to a normal distributor, you change a franchisee or you change an IP exploiter into, you terminate these kind of arrangements. Now you will have to be making termination payments, you will have to be making different kinds of payments in order to put an end to these commercial agreements. Now they will be tested in the Indian jurisdiction, whether the payments are adequate, not adequate for the business that has been driven away. Apart from the fact that, the Italian company would now like to see the onshoring of the manufacturing, cut down on the supply chain, which is at a huge distance, and so on. So all these issues are bound to give rise to transfer pricing disputes, as I see it.
I'd like to make one last comment also in tying to Marikla's point, a very good point about onshoring, and that's just this. In these times, certain functions that would otherwise, under normal conditions, be seen merely as routine functions, in the midst of this crisis, are elevated almost to the point of being seen as though they are non-routine. For example, disruptions to supply chains mean that the procurement activity, the procurement function takes on a higher level of importance, as does the maintenance and development of customer relationships. So, we often talk about functional analysis being the centerpiece of every transfer pricing analysis. Actually, there's a big missing link in the transfer pricing analysis, because a functional analysis tells you only who does what. It doesn't tell you the value of who does what. And in our reports, what we do is we input contribution analysis. A contribution analysis tells you the value of who does what. So when we're thinking about restructuring operations or how companies are reacting in the midst of the crisis, just keep in mind that certain functions may increase in importance, some may decline, and that what's the vehicle for getting that message across in the analysis. Think about a contribution analysis to supplement your functional analysis.
Yes, Vijayashri.
Yeah, so my take, just a very brief point, is the Indian government should actually tap this opportunity to relax the TP provisions. And I think understand the difficulties that we are facing and should be one of the first to kind of take up this opportunity. And plus, as we see that globally manufacturing units are looking at India as an opportunity, I think this is the kind of right opportunity for the Indian tax authority, especially from a transfer pricing side, to make to relax certain provisions or come out with certain good thoughts or provisions around or help businesses so that this will encourage more foreign investments in India.
So I agree with what Vijayashri said. I think it's time that the CPTT comes out with some clarification on the burning issues, so that at least total litigation cannot be avoided, but at least if some minimization takes place and if some guidance is there for the tax office, it will be good.
And I think what everyone is looking also is for tax certainty. So we have a certainty in our tax regime. Now, if we had the safe harbor rules also have got extended, but probably that could be an opportunity, could have been taken as an opportunity to revise the safe harbor margins, considering the swan economy that we are getting into. But yes, there's a lot of work which I think needs to be done, and a lot to look forward to.
Last remarks, not only from a transfer pricing, but is connected as well, exit tax, especially when you are moving activities, substantial, going concern back and forth through, for realizing onshoring or offshoring, whatever, you have to think about the exit tax implication and valuation and potential, tax litigation, especially in India. So it might be very, very wise to have an advice before doing anything.
Yeah. Hi. Just from my side, I would keep it very, very brief. And I think two sentences that one, this will be a time for all governments, not just India, to show that this is not an opportunity for garnering more tax and creating an adversarial regime. And therefore, the action would have to be largely collective. It will not really, I don't foresee it to be an action that only Indian tax authorities will take. There will have to be a collective thought process put together. And I just hope it happens in a timely way.
Just one more point. Hello?
Yeah, go ahead, Vijayashri.
Yeah. So I just had a thought taking Shika's remark that should there be a multilateral instrument for TP provisions across, so that it's more consistent across the groups. That was one thought that I.
So Priyanka, concluding remarks from you, and we end the session.
Yes, I think we have captured what we could in this short 2-hour duration. Of course, we have a lot of other things to discuss about, which we can in our webinar. I think with this, we can nice evening, all of you, and hope to see you soon again in our next webinar.
Thank you. Thank you, everybody, for joining.
Thank you.
Thank you. Bye-bye.
Thank you.
Bye.